Я маю, зараз відкриваю, Сашко, він же ж о 5 починається в нас. Те, щоб ми просто раніше підключилися, щоб перевірити ще раз. Так. Ну, я зараз, ось хай працює. Зараз я бачу, що тут Ільчук теж підключається, Корнілюк, Долуденко, тому зараз я всіх підключу вже. І може, щоб вже було відкрито. Да. Я тебя прошу пойти и доиграть. Мне сейчас нужно сосредоточиться, хорошо?
Маме, с тобой тихо посидим.
Нет. Мне сейчас нужна тишина, пожалуйста. Хорошо? Отойди, пожалуйста. Мне нужно пространство. Так, Сашко.
Hello, everybody. Thank you for joining. We'll wait for another 3 to 4 minutes to let everybody in, and then we'll start. Just bear with us for the next 3-4 minutes, and we'll kick off. Thank you. All right. I see that we have close to 40 people, so critical mass is there, and I trust we can start. So my name is Vitaly Radchenko, and I'm a partner with energy practice of CMS in Kiev. And today, the topic of our webinar is an investment treaty arbitration and the Ukrainian and options for the Ukrainian renewable energy sector investors. Our webinar is held together with King Spalding, our colleagues and experts in arbitration. So the team who will be presenting to you today is Ken Fleurier, Amy Frey, both from Paris office of King & Spalding, and Reggie Smith and Kevin Moore from Houston office of King & Spalding. And on the CMS side, that would be myself, Vitaly Radchenko, and our dispute resolution partner, Alexander Martinenko. So where do we start? We don't want to perhaps spend too much time on the introduction of the King & Spalding and CMS. You will see all the slides with our credentials and track record in the presentation that we will send to you after the call. Together with the recording, and you will be able to learn about the cases we've done, the clients that we have, and the wins and successes that we had in representing clients in arbitrations and also in renewable energy transactions. So all of that I will just leave for later. If you have any questions about our experience or particular cases or circumstances, just let us know after the call or even now. You can ask your question in the chat window. It should be available to you. And you can ask your question, and if we have time, then we will address it right on this call. Or if not, then we'll pick it up later and we'll contact you to discuss it after the call. But to start our webinar, I would probably start with the current situation. And that is why we are here, why are we raising this as a topic for discussion with our clients, existing and potential. So on this graph, you can see that Ukraine has seen quite significant boom in renewable energy investments and in general in commissioning of a new renewable energy capacity. So you can see that over the last 3 years, we grew to probably, what's it now, 7 gigawatt as of May 2020. And that already represents 12.7% of the total installed capacity of the generation in Ukraine. That is quite significant. The problem started recently, I think beginning of the year. The off-takers stopped actually paying in full and in time to renewable energy generation, quoting the deficit. We will talk about the deficit later, but the off-taker estimates that the deficit will run into probably close to 1 billion euro by the end of 2020. Now, both the government and the off-taker TSO blame stability and balancing problems of the system on renewable energy generators. And some of you may also experience curtailments already, which TSO says are inevitable because TSO does not have, TSO, transmission system operator, named Ukrenergo. They claim that they do not have the capacities, the balancing capacity, or maneuverable capacities that can balance this much of the renewables in the grid. So they say that the curtailments are inevitable because they need to ensure the stability of the system. Now, what's killing is the fact that those curtailments are not being compensated, even though the law suggests they should be. So the government sees the solution in the following, so far, two following ways how we can achieve the solution. First is to restructure the green tariff scheme, also the feed-in tariff scheme, and the negotiations in that respect right now are ongoing with the government under the auspices of the Energy Community Secretariat. So that this is so-called mediation effort. And also the government thinks that once the restructuring is over, Ukraine can switch to the auctions, and that would also provide some sustainable solution for further development of the renewables. Now, also we shouldn't forget that we also living in a new market, new electricity market conditions. It has just been liberalized from 1st of July 2019. So now we're about 1 year old market. So everything is still new, still some segments of the market are untested, like auxiliary services market, etc. The balancing market was not working properly, still maybe not. So all those problems due to kickoff of the new market, they also add up to the problem. But most of all, there's so-called public service obligation, which is imposed by the government. And it's basically a manual controls over the price caps, over how the electricity is being sold by the guaranteed buyer, whom and for how much, when, and to whom exactly. So all of that obviously does not add to the stability or sustainability of the market and creates more problems. Now, don't want to spend too much time on the timeline. You will see the timeline over here. It started from the, some statements from the parliament that renewable energy generation is just, we are wasting money on it. They're just enjoying preferential tariffs, etc. And now all of that started spinning into some draft laws in the parliament, huge discussion in investor community, and then finally reaching the point where the investors addressed their concerns to the Energy Community Secretariat, which raised the dispute with Ukraine about that and started the mediation process. Now, two associations are part of that mediation process, European Ukrainian Energy Association and Ukrainian Wind Association. And so this process is still ongoing. And on the other hand, you have a Ministry of Energy and basically Ukrainian government who are the parties to that mediation. So this is just the timeline of how much and how many times the government and investors were going back and forth. There were various proposals submitted by the government, voiced by the investors. But today, 5 months or even more into this process, we're still there. There's no agreed position between investors and the government. And myself, I'm not even sure when is that going to be achieved. Because to the latest proposals from the investor, the government still came back with something, and I'll stop on that just later on. So this was the, again, quickly, this was the proposal of the investors. After all the talks, the investors were willing to go for, some decrease of the tariffs with prolongation of the PPA terms, and some additional, bells and whistles on them to follow the balancing rules. But obviously, the investors want to be paid quickly, still by the end of the year. With all those remaining debts, outstanding debts of the off-taker. Now the government just took everything and basically deleted some of the wishes on the investors' wish list. They said no extension of the PPA. You need to cut your tariffs even more. You need to introduce your balancing responsibility even earlier, and basically, it will take us longer to repay your debts. So not constructive at all, and we are not yet confident when this process will end up. This is the table. Again, this is just our unofficial table that we could find and spot various curtailments precedents, but you can see that their number is really growing. And this is what's troubling some of the investors who are being cut off and who are not being paid for it, because basically TSO and guaranteed buyer are pointing finger at each other and saying that, sorry, there's no compensation procedure, we can't compensate you, sorry, tough luck. This is obviously is ridiculous. Now, then we come to the off-taker who has this huge deficit already, and this deficit is going to grow even more, given that on one hand you have a guaranteed buyer who is buying electricity from the renewables, selling it on the day-ahead market, and then receiving the other part of the compensation from the TSO basically as a service, and then pays all of that back to renewables. Now, this is the deficit of the guaranteed buyer, and it still has a bigger chunk of it is not coming, is basically TSO is not paying its share of what it should pay. This is another slide to underline that. 11.2 billion already of the debt between TSO and the guaranteed buyer. You see those graphs and tables with the level of payments for the year. You can see that May, April, March, April, and May they are not fully covered by payments at all. So this is obviously this obviously raises concerns with the clients as to how long is that going to continue and how sustainable this payment system is. And the question is that even if you sue the guaranteed buyer in Ukrainian courts or whether you're in arbitration, the guaranteed buyer is just a pocket of money. It takes the money from the consumers or suppliers and then transfers it back to renewables. So it has limited sources of where the money can be coming from. It has a big debt from one of the main sources of its funding, which is the TSO. So it's basically financially unsustainable. It's bankrupt as of today. If that would be allowed to even bankrupt the guaranteed buyer. So even if you sue the guaranteed buyer, it just doesn't have the money. So that arbitration against the guaranteed buyer itself under the PPA is problematic, because then even if you win it, you will spend the time, but you might not get the satisfaction that you're seeking, which is the money, and they won't have it unless there's a solution found to their sustainability and financial cash flow. Now, Ukrainian law has a number of guarantees that the state has promised to the investors. One of them is found in the law on the alternative energy sources, and it says that the payment for the renewable energy guarantee for the renewable energy electricity should be in full, on time, and always with monetary funds. So no set-offs, no promissory notes, monetary funds, cash on your bank account. Another guarantee obliges the off-taker to buy whatever the electricity is being generated by the renewables at the guaranteed fixed green tariff rate and for the period of green tariff application. Another guarantee also says that the transmission system operator shall give preferences to the producers from the alternative energy sources, which means that they have to be connected to the grid and cannot be rejected. And there are more guarantees that relate to the moment when the green tariff is granted, than to the investment and stability of the legislation, stability of the contract and its provisions, and basically stability of the contractual and regulatory regime. So all of that you will see on those slides. I don't even want to mention that in greater detail. You will see them in our presentation after the call. But that leaves us with the question, what's happening now with the MOU? whether the agreement, even if we agree to MOU as the investor, whether the state is going to deliver on their promises, because there's a long list of the obligations of the state which are part of the MOU, to adopt a number of laws, to adopt a number of regulations, to make the system sustainable. But given that the state is not willing to go as much further as to say that yes, there is a source of funding, and usually that source of funding is obviously the consumer. In Ukraine, we're still having the cross-subsidization of various types of the consumers. So now the industry pays more than the residentials for the price of the electricity, while in Europe and other countries, it's the other way around. In those conditions, obviously, unless there's the willingness to move on the tariffs for the transmission system operators services, that is how the law is supposed to work, and to raise the tariffs and to collect those tariffs, in our view, we do not see how this formula, how the structure of the market can be made sustainable. So with that in mind, I complete my part of the presentation, and I would like to hand over to the team from King & Spalding for them to introduce themselves and also to pick up on the most important points that are relevant for the investors in the cases like this, when the state has failed on many of the promises, on many of the guarantees, and the negotiating process may not be what you would want it to be like. So without further ado, I would like to pass the floor to Amy.
Hi, everyone. I'm Amy Fry from King & Spalding. Actually, I think we're going to start with my partner, Ken Fleurier, to introduce our side of the team and kick off our discussion.
So, well, good afternoon to everybody. It is a pleasure to be able to introduce my colleagues at King & Spalding and tell you a bit about our ECT arbitration practice in the renewable energy sector in Europe. Joining me today are Amy Fry, whom you just heard, Reggie Smith, Kevin Moore, Simon Maynard, and a few of our other colleagues, all of whom have been involved with me over the past 5 or 6 years in pursuing arbitrations under the ECT against states in Western Europe as a result of their cutbacks in the renewable energy sector. I'd like to try to make this presentation today as practical as possible and really talk about specific cases and experiences, and I would welcome any and all questions that anyone might have through the chat room and or through follow-up with us directly after this event is over. Just very quickly, King & Spalding has about 1,000 lawyers worldwide. We have 110 lawyers approximately that are full-time lawyers in our international arbitration practice. Our international arbitration practice is based all over the world, including a number of locations in Europe. Our arbitration practice is particularly specialized in the type of arbitration that we're going to be discussing today, which is generally referred to as either a treaty arbitration or an investor-state arbitration. We have probably, of our 110 lawyers, about 60 to 70 that work full-time on investor-state arbitrations or treaty arbitrations. More to the point and more relevant to this phone call is that we are currently handling 20 20 arbitrations under the ECT against Spain, Italy, Romania, and Bulgaria. All of those cases, except for the 2 cases we have against Romania that involve green certificates and sort of the demand side of this market, all of the other 18 cases against Bulgaria, Spain, and Italy involve cutbacks to feed-in tariffs. We have so far prevailed in 5 of the 6 cases that have resulted in awards to date. And I'd like to tell you in my remarks today a bit about how we've pursued these cases, how we have structured claimant groups, and then Amy and some of my colleagues, Kevin and Amy in particular, are going to talk about some of the specific issues that we have faced in the cases. But we have a large team that's already, deeply into this general topic in Europe, and our 20 ECT cases are by far more engagements than any other law firm. I'm going to try to share my screen if I can figure this out technologically, because I've got a couple of specific points that I would like to cover with use of slides. Let's see. And I wanted to start with the topic of, let's see. Who can be a claimant in these cases? And again, I'm doing my best to make all of these comments as practical and as useful and as helpful as possible. But one of the first things that I would note is that the Energy Charter Treaty, as well as many bilateral investment treaties, cover what we refer to as indirect investments. I have an example of a structure on the slide in which, hypothetically, let's say a Spanish company has invested in the Ukraine, but it's done so through a BVI company, so that the BVI company is the direct owner of the Ukrainian company. Because the ECT, as well as many BITs, protect what are known as indirect investments, there would be no problem with the Spanish company serving as a claimant in this case. And in fact, there would be no problem with the Spanish company serving as a claimant in this case if there were 3 or 4 or 5 or even more intermediate companies between it and the Ukrainian company. Furthermore, there would be no problem with the Spanish company serving as the claimant in this case if it was simply somewhere in the middle of the ownership structure, and had companies in other countries that are not members of the ECT, both below it and above it in the ownership chain. The only way that an indirect investment would run into trouble in terms of the company in question being able to serve as a claimant would be if it was ultimately owned by Ukrainians, and there the rules are a little bit more complicated and a little bit more challenging. But the basic point I was trying to make with this slide and would like to make is that indirect investments are covered. And of course, we'd be happy to look at any investor's investment structure to advise more specifically on this. But as a general proposition, the ECT covers indirect investments. And so, for instance, in many of our cases against Western European companies, our clients are simply somewhere in the ownership chain. They do not need to be the direct owner of the host state company that is truly sort of the operating company in the host state. So there's a fairly wide coverage under the ECT and BITs in terms of indirect ownership. Secondly, there is a way for Ukrainian companies to potentially serve as claimants in these cases. This is a slightly more complicated topic, but essentially while the ECT is generally designed to protect foreign investments, and while in most investor state arbitrations you use a foreign company as a claimant, there is in fact a way for Ukrainian companies to serve as claimants in these cases if they are either directly or indirectly majority owned or controlled by investors in another ECT state. So for instance, in this scenario that I've got on the screen right now, I've got a Ukrainian company that is owned upstream 25%, or excuse me, 25% by another Ukrainian company, but 75% by foreign companies. In this scenario, the Ukrainian company below could serve as a claimant in the case, and the advantage to it doing so would be that it would be allowed to claim for 100% of the damages that it suffered. Of course, you could also bring a case simply on behalf of the foreign companies, but in that scenario, you would only have a damages claim for 75% of the damages suffered that equate to the foreign ownership. But keep in mind, just as a general takeaway, that if there is foreign ownership and control, it is actually possible under the ECT and under the ICSID Convention to bring a claim on behalf of the local domestic company under what's known as the foreign control exception. Let me also say, before turning to the next topic, that we have had some questions in the past few weeks about potential group claims, and we have in our existing 20 ECT arbitrations, I think a third of our cases have been brought on behalf of claimant groups. So it is certainly possible for unrelated claimants to join together, essentially, and bring one single ECT arbitration against the Ukraine. The reason you would do that, perhaps, might be that in banding together, it is much easier to make the costs of the arbitration worth it if you're paying those costs directly. We also, in some of our cases, use litigation funding and other mechanisms to help finance cases. And it may be that you need to band together in order to achieve a certain scale in the overall total damages claim, such that a funder would become interested in your case, because typically funding is only available for larger claims. But we do have a lot of practical experience in putting claimants together in groups, and I can answer any questions you may have either during this presentation or later about how that works in practice. We have our clients typically sign a intra-group agreement that governs decision-making in the arbitration, governs how damages that are ultimately awarded will be split, and so forth. But it's something that we have very practical experience doing. I believe we've done it in seven of our 20 existing ECT arbitrations. Why, briefly, would you pursue a treaty claim instead of domestic remedies? The basic answer is that under the ECT, you get an independent three-person tribunal that is independent from any political pressure, and you're likely to achieve a much greater damages recovery than you would if you pursued domestic litigation in the Ukrainian courts. I'm not an expert on domestic litigation in Ukraine. Our colleagues from CMS on the line are, but I can certainly tell you, given what we've seen in countries like Spain and Italy, that in broad terms, domestic litigation challenging the government's measures has been unsuccessful, and I would be surprised if the outcome were any different in the Ukraine. Also, because of the protection of indirect investments, and because the standards of protection in the Energy Charter Treaty and under international law are generally quite broad, the arguments in the case are somewhat easier to claimants or plaintiffs, perhaps, than they would be under domestic law of a country such as Ukraine. Essentially, the key legal argument in these cases is that Ukraine has acted in a manner that is unfair. And that's a broader legal standard, and that's something that is generally easier to prove in many situations than what you would have to prove in a domestic claim against the government. I've got on the slide now just a very high-level overview of a treaty arbitration. I've mentioned a couple of these points before. On a practical note, I would say that these arbitrations typically take about 2.5 to 3 years. They are not the quickest thing in the world, but they're not the slowest thing in the world either. We have generally been able in our other 20 arbitrations to date to get to the final hearing in a period of about 2.5 years. It can then take a bit of additional time for the tribunal to complete its award. Once you obtain an award in these cases, there is a limited opportunity for the respondent state to challenge the award. That's happening now in a number of the Spain cases. If you have brought an ICSID case, you have to file the challenge before an ICSID annulment committee. But the other main benefit of these cases is that ultimately these arbitration awards are enforceable throughout the world. Many of the Spain claimants and the Italy claimants that have prevailed, for instance, are right now pursuing enforcement actions in the United States. They're doing that to a large extent to avoid the European Union interference, which is far more limited in U.S. courts than it is in courts in Europe. They're also doing it because the United States gives them very broad discovery rights, and so the awards that started some years, the cases that started some years ago, including against Spain and Italy, that have already resulted in awards, are now, the enforcement is now being pursued in the United States. And I would note that our firm also, unlike many arbitration practices, does handle enforcement actions. So we really we don't mind getting our hands dirty, and we represent clients essentially from cradle to grave in terms of ultimately also helping them enforce the awards and obtain payment. I will note as a general matter that the payment track record in these types of cases is generally quite good, and most treaty arbitration awards are eventually either paid or settled, even though it can take some number of years for that to happen. With that, I'm going to stop my remarks and turn it over briefly to Amy and a couple of my colleagues just to talk about a few of the key issues that we have seen in these cases. And then we'd like to leave some time at the end of this presentation for questions, including answering some of the questions that have come into the chat room. So thank you very much.
Thanks, Ken. Hi, everyone. Again, I'm Amy Fry, and I wanted to just take a few minutes this afternoon to discuss with you some of the experiences we have gained from our international arbitration proceedings involving Spain, Italy, Bulgaria, and Romania. As we watch what's happening in Ukraine and have been following it for the last several months, we see tremendous similarities there compared to what we also saw in Spain beginning in 2013, in Italy the following year, and then in Romania and Bulgaria. So for example, we saw politicians in those countries start this process by claiming that the renewable energy investors were receiving a windfall, that the tariffs were too high, that the system was unsustainable. And this led, of course, to the reforms that have formed the basis of dozens of treaty arbitrations against those countries. So far, with respect to the claims against Spain, if my numbers are accurate, and I think they are, 20 cases have resulted in awards to date. Spain has prevailed in 3 of those cases and has been held liable for violating the Energy Charter Treaty in 17. I will get into a bit more detail about the findings of those cases because they do vary somewhat across the 17 cases in which Spain has lost. And this might be relevant, of course, to claims that you may be considering raising against Ukraine. With Italy, the track record is a bit more balanced. Italy has won 2 cases and lost 2 cases so far. The measures that Italy enacted and the reform that Italy carried out was somewhat less significant in terms of financial impact to investors, and we think that probably played into why Italy has been able to prevail in some of the cases, although not all of the cases, and I'll show a bit of that in a minute as well. There aren't yet awards in cases against Bulgaria and Romania. Those are relatively recent developments, and the cases are in their early stages. So that's kind of the state of the track record involving renewable energy disputes in Europe. Now, all of the cases that we're handling against Spain, Italy, Bulgaria, Romania, they involve the same types of claims that we assume and contemplate will be at issue in cases against Ukraine. So that is a cut to the promised feed-in tariff itself, changes in the duration of when that tariff might be paid, curtailment of the electricity production that's eligible to receive that payment, and additional costs associated with exposing investors to the risks of balancing and various balancing costs, in addition to other unexpected costs and fees that countries, the countries that we're working against now, have also imposed on investors. So we think that a lot of the legal arguments we've seen from the respondent states, the strategies that we've employed to successfully pursue these claims on behalf of our clients will be absolutely relevant to the cases that you may be bringing against Ukraine. In all of the cases in which the respondent states have been held liable to date, the tribunals have found that the states have violated the specific provision of the Energy Charter Treaty, which is the duty to provide fair and equitable treatment to investors. Ken mentioned this just a few minutes ago, but the way that that notion is interpreted by tribunals does vary from case to case. So I wanted to just take a few minutes and show you how some tribunals have interpreted that provision, just to give you a sense of what you may be required to establish or prove in an eventual case. And I'm going to pause just for a second so that I can share my screen when I do this as well, just to give you a bit more insight. If you'll bear with me. Okay, well, I seem to be having some technical difficulties, so I can not waste the time with that. I'll just tell you what I intended to show you. So in broad terms, the tribunals that have found states violating the fair and equitable treatment provision have reached that conclusion as a result of one of 2 different interpretations of that standard. So on the one hand, you have tribunals who have found that the renewable energy reforms that were carried out undermined the quote-unquote legitimate expectations that investors had when they decided to invest in the country. So we have been able to show, for example, in a number of our cases against Spain and Italy, that when the claimants in those cases decided to make their investments in the country, they expected a defined feed-in tariff or a defined amount of time on a specific amount of electricity. And in most cases, it's all the electricity that the plants could generate. Any change to that basic expectation, we argue, is a violation of the investor's legitimate expectations and therefore a violation of the treaty. And we have prevailed in some cases on that argument, which is kind of the strongest iteration of fair and equitable treatment, because it means that any change that undermines what you expected when you invested is a violation, and you can be compensated for the harm that results from that. Now, I will say that finding which we have been able to secure for our clients in a few cases, is in the minority of decisions. The majority of tribunals that have found these countries liable have interpreted that provision somewhat differently. So the majority of tribunals have found not that, excuse me, let me back up. The majority of the tribunals have rejected the notion that it was legitimate for investors to expect no changes whatsoever. And instead, they say it was only legitimate for investors to expect that the country would not enact fundamental changes. So a majority of the tribunals finding Spain liable, for example, have found that Spain's reform as it exists today was a fundamental change when compared to the investment framework that existed when the investors decided to invest. Now, the problem with that legal standard is that there's not a lot of definition given to what makes a specific reform or a specific change fundamental. And so that's where the case and the arguments focus. And in the Spain cases, what that has meant is that the tribunals have actually found Spain liable for cutting the feed-in tariff and the amount of remuneration that was initially promised to investors, whereas they found that Spain did not violate the treaty in enacting what the tribunal considered to be more minor measures, which in Spain happened to be more modest curtailment issues. So for example, production cap limitations. Now, part of that has to do with how harmful that cut was quantitatively to a specific investor. We've argued actually that you shouldn't be looking at the magnitude of the harm imposed. You should be looking at the changes in risk allocation. So in other words, when an investor goes into a country thinking that the economic framework is going to be one way and structures its investment and its financing accordingly, then any change in that structure is a fundamental change because it doesn't take into account, or it doesn't allow the investor the opportunity to alter their investment structure in light of the change. So that's just to say that the fundamental or the primary legal standard that we think will be at issue in your cases is fair and equitable treatment, whether it's interpreted as a violation of your legitimate expectations or whether it's interpreted as a fundamental change in the investment environment under which you may have invested. We think that you can pursue a claim arguing both iterations of this standard because there's a lot of overlap between the two of them. And in fact, the difference between the two of them really comes in sort of where you draw the line and what's fundamental and what's not. Now, what we've also seen that's common across the cases that we've handled to date are the state's defenses. So the state typically claims that its measures, its reforms are justified because the state is sovereign and has the right to regulate and can change its laws in the face of changing economic conditions or changing policy priorities. So we've been able to successfully defend against that argument by showing the nature of this sector as highly capital intensive, the actions of the state to induce the investment on the front end and what commitments the state may have given to the sector in order to obtain the investments that it needed. And these are the kinds of elements that we want to see and want to use in order to pursue these cases and what makes a stronger case. I wanted to make a quick note about some of the questions I saw in the chat because I know that there had been some discussion about the guaranteed buyer and whether a claim could be brought based on the fact that the guaranteed buyer in Ukraine is basically defaulting on its obligation under the PPAs. Our understanding is that the guaranteed buyer in Ukraine is a state entity. So any acts or omissions that the guaranteed buyer may have undertaken can be attributed to Ukraine in an investment treaty arbitration. But you may not even have to get that far, or you may not even have to get into that analysis because that's really a question of whether you're trying to argue that the guaranteed buyer has violated the contract. And the treaty claim is a bit different. So the treaty claim is not, you've breached my PPA, but it's your actions, whether it's a law that's enacted or how the program is carried out in terms of who pays for what or when it's paid. Any of those acts that harm your investment, so whether that's because it violated a legitimate expectation that you had when you invested, or it amounts to a fundamental change in the framework under which you invested, any of that that's attributable to Ukraine can form the basis of a claim under the Energy Charter Treaty. Now, once you establish liability, which is, again, what I've been saying, once you establish that either your legitimate expectations have been undermined, or that what Ukraine has done has amounted to a fundamental change in the environment, or otherwise that Ukraine has treated your investments unfairly and inequitably, the next thing to show is that the harm you've suffered was caused by Ukraine's acts or admission, and then of course to calculate the harm, that is the damages that you've suffered. And my partner, Kevin Moore, is going to talk a little bit more about quantum and damages, but effectively, in order to bring one of these claims, you as the claimant would be bearing the burden of proof. And so you have the burden to establish your jurisdiction under the ECT, the standard of protection that has been violated, so that's liability, and then causation and damages. I think I'm happy to answer any questions about similarities we've seen across other cases or the legal standards, but for the moment, I'll stop now and let Kevin or others step in. Thank you.
Amy, before we pass to Kevin, there's been a couple of other by the way, the questions we've received in the chat room have all been very good. There's been a question as to whether it matters if the guarantees to stability were specific to an individual investor or general, such as guarantees in legislation. It is certainly a stronger case if there have been specific stability commitments made by a government, but much of the fair and equitable treatment standard in these cases also turns on general commitments that have been made. And in other words, it is in many cases it is sufficient to be able to demonstrate that there is a general commitment undertaken if that general commitment was specifically intended to target a potential class of investors. I mean, that's really where the rule turns. If the general commitment in legislation was essentially an offer intended for certain specific investors to accept by making their investment, as has generally been the case in these renewable energy cases, that has found to be sufficient, even in cases where a specific commitment was not made. There have been a couple of other questions on corporate structure that are very good questions that I'd be happy to answer and follow up by email. But in the interest of time, I wanted to let our partner Kevin Moore just speak for a couple of minutes about the approach to quantum in these cases and how damages are put forward by claimants, and just a little bit about what's happened so far in some of the cases that have been decided.
Yeah, I'm sorry, Kevin, to interrupt one more time before you get to speak, but just on this last topic, I saw a final question come in about the breach of the PPAs. And while it is true that a violation of the PPA could potentially also be a violation of the umbrella clause under the ECT, I wouldn't go so far to say that beyond that they're not relevant, because if we can show that a state entity violated a contract, then that's very close to showing fair and equitable treatment has been, or I'm sorry, that the state has not afforded the investment fair and equitable treatment, because it's reasonable for an investor to expect its contract to be honored. And so I wouldn't say the breach in and of itself establishes liability under fair and equitable treatment, but it's certainly solid evidence, A, of your expectations, because you expected your contract to be performed, but then also it's just solid evidence of the harmful conduct or the misconduct of the state. that all.
And also just more generally, this is governed by international laws of state responsibility. The topic is not governed by the domestic Ukrainian law or the contract provisions. So in other words, whether or not you've got a claim directly under the contract, whether or not the state of Ukraine is responsible is a question that's governed by international law. But Kevin, we're running low on time. Maybe you could just in 5 minutes give a bit of an overview on what's happened with quantum in some of these cases.
Thank you, Ken. So I'm Kevin Moore, and my primary responsibility on our team is to work on the quantum portion of the case and to work with the quantum and regulatory experts. So I want to spend a few minutes talking about that. Quantum is along with jurisdiction and liability, quantum is one of the big three issues that a claimant must prevail upon in order to win a treaty arbitration. The main metric of quantum of damages in a treaty arbitration case like this one, like a case against Ukraine under the facts that we know now, would be the diminution and the fair market value of the investment. So if we're talking about a claim by a foreign entity that owns a domestic company in Ukraine, that would be the diminution in the fair market value of the equity or shareholder loans. If the claimant is the local enterprise itself under the foreign control argument that Ken discussed earlier, then the metric would be the diminution in value of the enterprise, the entire enterprise. And the standard way of measuring that diminution in fair market value is the discounted cash flow method. So a financial valuation expert prepares a valuation using the DCF method of what the investment would be worth with the measures in place and what the investment would be worth without the measures in place. And the difference between those two valuations is the damages, the quantum claim. In many ways, that is, or at least should be, a fairly straightforward valuation process. Because at least in this context of renewable energy plants under a regulatory framework that provides for feed-in tariffs, there's not that much room for legitimate disagreements about the valuation and the impact of a reduction in the feed-in tariff on the value of an investment. So in other contexts, for example, in an oil and gas investment or a real estate project or something, you would typically see the quantum phase of these cases focusing on the reasonability of assumptions in the DCF model around things like what the production or output level will be and what prices will be and what costs will be. A lot of that is simply not present in this sector. There's just not that much room for disagreement on those issues. But what we have seen in the cases against Spain and Italy and other countries in the renewable energy sector is that they are not satisfied with a position on quantum that suggests that there's perhaps 5% or 10% less harm than the claimants allege. They want to show that there has been no harm at all. And so what we have seen are much more creative arguments in quantum that really are ways of re-arguing the liability case through the quantum case. And there are really two big variants or components to those arguments. One is respondent states argue that investors really should never have expected that there would be no changes at all. They really shouldn't have expected that they could receive the feed-in tariff as guaranteed at the beginning without any changes whatsoever. All that they could legitimately expect would be a reasonable rate of return. And if that concept, if that liability premise is accepted, then that opens up numerous ways in which the respondent's expert can attempt to manipulate both the returns that it says that the plants are receiving and the benchmark rate of return that it says would be reasonable in order to try to make a claim, make an argument that in fact the investments are still doing just fine. And then the second flavor of argument that we see from quantum experts is that, in fact, it relates to regulatory risk. And what we see them often doing is applying a big regulatory risk discount in the valuation, the DCF valuation, in the but-for scenario, which really is just a way of arguing that some kind of change was inevitable. In our view, that is a way of re-arguing liability in the quantum phase, and we have been successful in refuting those arguments largely to date. And I'll just stop and say a word or two about the experts that are typically engaged in these cases on behalf of claimants, and there usually are two different areas of expertise in which we engage outside experts. First is financial valuation. That is usually a professional valuation expert who has experience valuing investments in this sector, both in the context of disputes, but also in the context of sale transactions, buying and selling and financing, et cetera. The second category of experts are regulatory experts who typically are PhD economists who have worked as regulators or advising regulators in this sector, and they have a great deal of experience and credibility speaking to what the best practices are regarding regulatory policy and regulatory frameworks in this sector. And those experts support not only the quantum experts, but they also support the liability case, because it's important, it's very important in these cases to educate the tribunal about this sector and what normal regulatory policy is in this sector, because it's important that the tribunal should understand why a state would give up its regulatory discretion to reduce tariffs after plants are built, to impose curtailments and things along those lines, because in fact that's one way, that's a best practice in this sector, because it allows the states to attract investment at a lower tariff than they would otherwise have to provide in order to attract investment if the investments were much riskier. So, for example, in the context of curtailments, we would have regulatory experts who explain why it is a consistent practice among regulators in this sector to provide a guarantee of priority of dispatch. That is a conscious allocation of risk, and of that, in fact, the ignoring that guarantee after investments have built is in fact a fundamental reallocation of the risk, going to the point that Amy made earlier. So with that, I know we want to leave time for questions, so that will conclude my remarks, and happy to answer any questions specific to those topics. Thank you.
While we're waiting for others who may have questions, one came up about restructuring your shareholding and your investment in order to secure standing to bring a claim. The case law on that suggests that it is permissible to structure your investment at the front end in order to have the protection of a treaty, but the case law is generally dismissive of investors who try to do that in the face of an existing dispute or a foreseeable dispute. So I think it would be very close in the present situation to try to restructure your investment now in order to gain protection of a treaty in light of these anticipated reforms. However, if you think you're not covered by a treaty and you have some foreign ownership in your corporate structure, you should at least talk to us, because we may be able to show you how you can actually bring a claim. A lot of the claimants that the investors that we originally spoke with before pursuing their renewable energy disputes in other countries first didn't think they had a claim at all. And then once we assessed their full corporate structure, we were able to show how a certain company could actually bring the claim on behalf of the investor who was speaking to us. So, obviously, if you know that you're fully Ukrainian, this may not apply, but if your corporate structure is at all more complicated than that, I would say, let us have a look before you think you don't have this option.
This is Reggie Smith at King & Spalding. The only other thing I would add is we have talked about potential claims in the context of the Energy Charter Treaty today. It may well be that by virtue of the structure of the investment of foreign ownership, there may be coverage of bilateral investment treaties as between Ukraine and other countries that for those that cannot benefit as being a signatory from a signatory country to the ECT. So there are other international remedies that might be available to those affected on this call.
In fact,
And,
we just
Amy,
we
there are
just got
two additional questions.
we just got a question about if a company was 100% owned by a Cypriot company, that would be offhand, that would be fine because Cyprus is a member of the ECT. In fact, we have one of our existing ECT arbitrations is on behalf of a Cypriot company. But Reggie's absolutely correct. There are certainly many cases we have looked at where, you know, the ECT was not applicable. In fact, I was just looking at a case yesterday, but a BIT is applicable. So I think in any event, we would really welcome anyone with a question about their particular corporate structure reaching out to us. It's something we could advise you on very, very quickly. One other point in terms of the reorganization, one of the other rules is whether or not you have other business-related reasons for reorganizing. So if you were, even though it may be getting quite late to reorganize now, if you had already been considering, for instance, a reorganization for tax reasons or for some other business reason, that might eventually help you survive any challenge to a reorganization now. So we'd be happy to talk about any of these topics in much more detail with you. We have experience in all of these topics, and it would be fun and interesting for us to speak further with you. Vitaly, I know we wanted to keep this pretty much on schedule and on time. I turn it back over to you for any concluding remarks, or if there's anything else you think it would be good for us to address, let us know.
Yeah, just trying to set up my video back. I think, yeah, we planned for 1 hour so that it's 6 p.m. It's 6 p.m. in Kiev, so we don't want to keep everybody for too late. But yeah, if somebody still have the questions remaining, and we see them in the chat window, if we can identify, yeah.
This is Narek. Hi, sorry, just a quick question if possible.
Hi, Narek. Sure, please go.
Hi, thank you very much to all the team for the presentation. Very, very interesting. I guess sooner or later, maybe some of us will become clients unwillingly, but maybe under this pressure. Anyway, I just wanted to ask a question with respect to the different types of possible claims, or depending on different types of the power purchase agreements. So as you know, there are two types. There are the currently generating facilities in Ukraine, which are not being paid, and also which might suffer from retroactive changes. And also there are the so-called pre-PPAs, which are the agreements which have not yet been realized, but have been developed and were planned to be invested. Our group of companies is mainly active in solar energy. We have more than a dozen plants constructed. We have pre-PPAs as well in the pipeline. And I just wanted to make sure to ask from your experience, whether there are any differences between these types of agreements, what can be claimed, or where the chances are higher. Thank you.
Mm-hmm. Okay, so maybe for King and Spalding lawyers, I would explain what Narek has probably meant in legal terms. There are projects that are already commissioned, already generating electricity for some time. So there's a PPA in place, the project is up and running. But there's also some projects that are not yet being constructed. They have the promise from the state that as long as they are commissioned, they will be granted the feed-in tariff. And once the power plant starts generating, they will be getting that feed-in tariff. But due to all this mess, they are not yet at this stage, the stage where they are commissioned and generating the electrons into the grid. So the question is whether those unrealized projects at this stage are somehow protected. I understand this needs some further research and into Ukrainian law treatment of those projects. But basically, the question is whether those not yet realized and generating projects can be granted some protection or not, in your view. I think that's the question.
Yeah, let me attempt a partial answer with the caveat that we would want to look at this question more closely rather than just giving an off-the-cuff response. I think there are two answers to the question. One is legal and one is practical. The legal question has to do with the extent of the government's firm and sort of unequivocal commitments vis-a-vis the pre-PPAs. I mean, for the operating plants, there's no question that they both have a legal claim, and many of them may have a sufficiently large claim to merit bringing a treaty arbitration, which is the practical question I'm going to get to in a second. But on the legal answer to the question, it would turn on the whether essentially the investors already have acquired rights, and I don't know the answer to that off the top of my head, and I'm loath to give an off-the-cuff response. There is one case against Italy that the investors lost when they essentially had a plant under construction and nothing more than that. But it very much turned on the Italian legal rules, which effectively did not give an investor acquired rights until they had completed construction and connected to the grid. If there's a good and arguable case that an investor in the Ukraine had what were essentially already acquired legal rights under the pre-PPAs, then that may be different here. The practical issue also, though, is the amount of damages that you can claim. And again, I don't know the size of the different sort of pre-PPA situations that we're talking about. But if the investment has not suffered as much damage as a result of the fact that the plant is not yet operational, then that could create some issues in terms of whether or not the ECT arbitration was financially worth pursuing. So I don't want to rule anything out. I think those would be the two key issues that we would look at, and we'd be happy to look at that further with whoever asked the question. Thanks.
Just to add one, sorry, Vitaly, but just to add one point on that. I mean, we've spoken to a handful of some of you and others just individually, and know that a lot of investors in Ukraine hold both types of assets. So if the question is, we know we're going to pursue arbitration in respect of our operating plants, should we also add in our so-called pre-PPA plants? I mean, I think we see no reason now why you would leave those out. You might be limited, as Ken mentioned, in the amount of damages you can claim for those plants. The case that he referred to that involved Italy was a different situation where the investor there only had an uncompleted plant. And I think a lot of the decision in that case turned on the fact that the plant was at a very, very early stage and not much had been actually put into the plant. So if you're, at a very advanced stage of development, you could distinguish yourself from that case in particular.
Thank you very much.
Yeah, Narek, do you have a follow-up or
it was just basically a very, very short comment. Thank you very much, Ken and Amy, very helpful. I think the question here with respect to the practical issue, whether or not the investor has money to fund this issue and how much to claim back, is the approach what it's going to claim back, the invested money or the lost future cash flow. So if it's the invested money, obviously, I guess it's not worth the game. If it's the future possible cash flow, it's a lot of money. So that's the main difference, which I guess,
Well, that's the perfect follow-up question. It's an excellent question. The historical rule in these cases was that it was hard to obtain lost profits and really use a DCF valuation model unless you already had a business that had been operating profitably for a period of time, such that the DCF modeling would not be viewed by the tribunal as unduly speculative. In recent years, really just in the last 3 or 4 years, our field has become a little more modern. And in a few particular cases recently, DCF methods have been used for investments that were not yet completed and operational. I don't know that there's a case yet in this particular sector, but for instance, in the mining sector, when you have proven reserves and you have a commodity such as gold that has a market value, there have been a few recent cases where the DCF valuation has been accepted, at least to some extent, for mines that were not yet operational, because essentially the tribunal said, even though this investment is not operational, we can tell with a relatively good degree of certainty and without a lot of speculation what it would have been worth, because gold or whatever the commodity is has a certain established price. I see no reason why, in theory, a similar argument could not be run here in relation to feed-in tariffs that were very predictable. But it's an excellent question. That's probably all I can say in the 45 seconds I've got for a response. I think that Kevin, I don't know if there's something you want to add on this point that might be helpful.
Yeah, so I would echo what you said, Ken, that there have not been any cases in the renewable energy sector in which a state has been found liable with respect to a project that was not completed, and that I think is largely because of the nature of the regulatory frameworks and the nature of the measures that have been enacted in the states where there have been a lot of claims to date, such as Spain and Italy. And so that really just hasn't come up yet. I think it is certainly that there is a legitimate legal and logical basis for claiming damages with respect to the fair market value of the project using a DCF method that would value the project based on the assumption that it would have been completed in the but-for scenario. I would expect states to argue strenuously that in that scenario, the tribunal should, if it's really going to find liability and award damages at all, should use a different method with respect to what is really a lost opportunity rather than a lost completed investment. So, for example, arguing that quantum should be based upon sunk costs rather than discounted cash flow, and that is, I think that is an issue on which there is room for significant disagreement within the jurisprudence. I wouldn't say that it's settled, but as Ken mentioned, that there is growing precedent that the use of the discounted cash flow method to value an opportunity, a project in development, is appropriate.
Mm-hmm.
Thank you.
Thank you, everybody. Amy, I was dropped out of the call for some time, but I see one message from potential from the investor. As you know, there are also many projects in Ukraine that are purely, Ukraine invested. Like there's local investor who has put his money into the solar power plant. So I'm not sure if this was touched while I was dropped off, but does it make any sense for those people, for those investors to structure or to claim anything, to rely on the international protection, the international treaty protection, given that they are local Ukrainian investors? And I think, whether the corporate restructuring would help in that case. And I'm sorry if this has been already touched in some way because I was dropped off.
It has been touched, but let me add a little more touch to it. I mean, part of the answer to this question, in all honesty, depends on what the Ukraine does in the future, right? I mean, in terms of what the Ukraine has done up to this point in time, as Amy discussed a minute ago, it's probably a bit tricky to restructure now because there is pretty clear case law that if the dispute in question was either already existing or clearly foreseeable, that a late in time restructuring is basically what's called in our field treaty shopping, and that is frowned upon. As I mentioned earlier, though, if it's a restructuring that was already being planned for business reasons, and you can show that you were already thinking about doing it, there have been a couple of cases where the restructuring has been allowed, where the claimants could give the tribunals comfort that they also had some other reason to do it. Now, if this is a situation similar to what we've seen in all the other 4 countries, and what the Ukraine has done so far has only been to take a couple of steps, but there is a bigger step or two coming a year or two from now, then yes, I think it might make sense to restructure, because then there's a much sort of stronger argument that even though a couple of things have happened so far, the bigger changes and different changes that come later were still not yet expected. So if the concern, if there's no other way anyway to have a claim, and if there's a legitimate belief that there is a material risk that the shoe is really going to drop in a much bigger and different way later, then in that scenario, I would say there's nothing to lose from a restructuring, assuming it otherwise makes sense, for tax and business reasons as well. So if, I would hate to tell anyone on this call that it's too late to restructure and have the Ukraine in a year or two do something much bigger and much worse that is arguably not the same thing that it's sort of threatening to do now, and for such a company not to have a claim. So I think if there's not much to lose, you should probably still do it. And when the time comes, we'll have to help you analyze whether or not you've then got a claim. But certainly if it's like what we've seen in the other states, where there were 5 or 6 different measures over a couple of years that then sort of culminated in a very bad, severe measure that is really what provoked all the claims to be brought. If that's the world we're living in right now with Ukraine, I would encourage you to restructure, and we'd be happy to help advise you on that.
This is Kevin. Let me just briefly touch on, there's a question regarding discount rate, and the specific question was, what would the discount rate range used in the court discussion?
Okay, that's the last one for today, I promise. Okay.
Related to the Ukrainian cases be, we can't put a number on that, but what I would say from our experience is that the discount rates used in the cases against Spain and Italy have been in generally in the 5%, mid-5s. The discount rate in a case against Ukraine, I expect would be somewhat higher because country risk in Ukraine would be higher than it was in Spain and Italy. I don't know exactly how much higher that would be, but I would say that when you put the regulatory risk issue aside that I touched on earlier, the discount rate should largely be the same in both the but-for scenario and the actual scenario. So the absolute level of the discount rate doesn't have as much an impact on the size of the quantum claim as the question of how you actually think about and apply regulatory risk, and whether it should be higher or lower in the but-for or the actual scenario. That's a very kind of detailed issue, and I'm happy to discuss that further offline with anyone who has questions about it. Thank you.
Thank you, Kevin. All right, so I think at that we will leave it. I thank everybody who has joined. I thank King and Spalding team. The slides of this webinar will be shared with everybody who has registered. And the recording will be as well. So do let us know if you have any follow-up questions, suggestions, comments, clarifications. We'll be happy to follow up with on any of that with you separately. Have a separate call. In any case, we're happy to help our clients and investors in their fight for their rights. And I hope to, I hope that this is not the last meeting and webinar we are having together. Thank you everybody for this, and stay in touch. Thank you.
Thank you.
Thank you.
Thanks, Vitaly.